Rainier Avenue Radio.
Ở Washington, hầu hết chúng ta đều đồng ý rằng con đường dẫn đến sự an toàn nhất là khi chúng ta đặt điện thoại ra khỏi tầm tay, nhưng điều đó không dễ làm. Vì vậy, hãy lan truyền thông điệp và làm gương. Trước khi bạn lên đường, đặt điện thoại của bạn vào hộp đựng găng tay, gài đặt nó với "không làm phiền". Yêu cầu bạn bè và gia đình của bạn cũng làm như vậy. Bởi vì khi tất cả chúng ta đều làm phần việc của mình, sẽ tạo ra con đường an toàn hơn cho tất cả mọi người. Chúng ta hãy cùng nhau đến đó. Một thông điệp từ Ủy ban An toàn Giao thông Washington.
This is Big Poppy, host of Jazz from the Cabinets. Join me each week for a listening tour of the first century of jazz, an eclectic mix of Dixieland, big band, cool jazz, bebop, contemporary jazz, world jazz in all forms. That's Jazz from the Cabinets with Big Poppy on Rainier Avenue Radio, streaming worldwide on rainieravenue.world.
Wash your hands, don't touch your face, wipe things down, clean up your space. When you cough and sneeze, do responsibly. If you feel you're getting ill, isolate at home and chill. No, you're not alone. Please pick up your phone and call 206-477-3977. King County 206-477-3977. Public Health 206-477-3977. King County 206-477-3977. Public Health Community Radio Station will provide you with more information. Say Rainier Avenue Radio. Your community radio station will provide you with more information. Rainier Avenue Radio.
Would you like to see when your favorite Rainier Avenue Radio show comes on? Check out our show schedule, updated weekly at rainieravenue.world.
Welcome to Rainier Avenue Radio. This is Afternoons with Monique, recording live in Seattle, Washington, every Thursday at 1 p.m. Good afternoon, Seattle. This is Monique Lee from the Afternoons with Monique show, and you are on Rainier Avenue Radio. Today, I have the pleasure of inviting one of our local talents, an economist that hail all the way from London, England, to Seattle, Washington. Mr. Matthew Gardner is a Windermere chief economist. He also sits on various boards in the city of Seattle. And before I get started, I would like to invite Mr. Matthew Gardner to join me on Afternoons with Monique.
I'm here.
Hi, how are you doing
Hello.
this afternoon, Mr. Gardner?
I'm well, Monique. How are you?
I'm doing well. Well, thank you for joining me on Afternoons with Monique. Before we start with our questions and answers, I always want to take a moment to get to know you and learn a little bit of background about you. So my first question for you is, how many economists does it take to change a light bulb? It's a joke. It's probably an easy one for you, right?
I'm an economist. There could be 100 different answers.
Right?
So I don't know. How many economists does it take?
Well, let me see. According to the internet, it's number one answer would be, here you go. The first one is none. The darkness will cause the light bulb to change itself.
Oh, good Lord. That's terrible.
And I'll give you one more.
Okay.
None. If it really needed changing, market forces would have caused it to happen.
That is actually very accurate. So yes.
Well, before we get to the Q&A of the local economy, the real estate economy, and some other questions that you know a lot about, very knowledgeable about, let's get to know you. Where are you from, and your economics degrees. Where did you learn all the things that you know? So let's first start. How did you come to Seattle? Where were you from?
Oh, well, as you mentioned earlier on, originally from England. I was born and raised in London and educated either in London or out in the home counties, fairly close to downtown London. Lived there until I finished my master's degrees before I actually came across to the US, initially to Harvard. And actually my sister was already here in Seattle. She was actually working for Microsoft way back when. I showed up to have a visit with her. I looked around and said, well, who analyzes real estate around here? And quite frankly, back in the early 90s, no one did. Builders pretty much licked their thumb, looked around and said, okay, I will build that. And because of that, it really kind of drove my decision to move here. I then set up my own consulting company, which I had for about 20 plus years before I joined Windermere formally as their chief economist back in 2015. You mentioned about education. I got my undergraduate degree in economics from St. John's College, Oxford, and my master's degrees are in economics and econometrics, and that was from the London School of Economics.
Now, I understand that you've been analyzing economies and economics for 25 years. And
yeah, it's been a long time. I'm that old.
I don't think anyone that is around my age cannot be that old. So, and you have a weekly show called Mondays with Matthew.
Right. It's actually monthly, not weekly.
Is it weekly or monthly?
It's monthly. It was weekly a couple of years ago. Now it's monthly. I just it is a time constraint. So yes, the first Monday of every month.
And where can people find the material that you put up on the internet? Can people access it?
Sure. They can do it either through Windermere's YouTube channel, or you can follow me on Facebook, and that would be Matthew Gardner, Chief Economist, Windermere. Those are the two major ones. Obviously also on Instagram, which would be mgardnerecon, and on Twitter as well. Same handle.
What got you interested in economics and the world economies?
Well, essentially, actually, when I was accepted to go up to Oxford to take my undergrad, my mother said, well, what are you going to do with an economics degree? Mm-hmm. I said, well, Mum, every decision you make, I can find an economic principle behind it. Therefore, I should always have a job. At which point she says, great, keep on going. But she didn't quite realize I was actually not going to spend 3 years in university. I was going to spend 12. So kept on going through academia for quite a long time. But I just found it fascinating because literally every decision we make, and economics is a social science, which makes it actually remarkably difficult to forecast. But you really kind of look at it on the bigger picture. We make a lot of different decisions. What drives those decisions? And I need to look at those when I'm looking at demand for housing, or in essence, how the economy is going at any one time.
Indeed, it is interesting. But some of us, the people that are not doing what you do for a living, sometimes they look at the Economist, the new magazine, and there, there's so many words and they're all small prints, and they just fall asleep. So we're trying to make it interesting today. Some of my questions that I have for you may sound very specific, but as I had a chance to watch your videos as well as talk to you on the phone, your explanations are very easy to understand. So hopefully, if ladies and gentlemen, if you are watching and if you have questions, please feel free to send it in, and Mr. Gardner will be happy to answer. And if it sounds good and fitting with our theme, I would definitely post it to Mr. Gardner. So you have a lot of videos about market conditions, particularly about real estate market in the Northwest and in the U.S. In addition to the real estate market, occasionally you would segue into other markets that relate to real estate, such as cryptocurrencies and blockchain technology. So on one of your videos on March 28, 2022, you made a lot of observations and also some sharing with our audience, the audience, some thoughts about cryptocurrencies and blockchain technology. So do you think that cryptocurrencies and blockchain technology are here to stay?
A great question. And I'm actually rather split in this respect. And I'll try and explain to you why. Blockchain technology, absolutely, I am a big fan of. I think it's got legs. I think it's going to be around for a long time. And for reasons maybe I'll get to in a couple of minutes. As far as cryptocurrency is concerned, however, this is something which tends to really bifurcate people. People are very much on one side of the fence or the other. Am I a fan? I'm afraid not. And there's lots of reasons why. It's interesting when you think about what's going on in the crypto world. I mean, it's been around for a long time. But I call it the decentralized finance bubble. It's actually bursting. I mean, NFTs, non-fungible tokens, that craze is burning out. Even algorithmic stablecoins. And what I mean by that, algorithmic stablecoins are ones which are actually fiat backed, which means they can be backed by gold, they can be backed by currency, the dollar, and it can even be backed by the cryptocurrencies. Well, even those aren't protected. I mean, Voyager went under, I filed Chapter 11 not that long ago, Terra USD, lots of these other companies. I mean, with Terra USD, it was basically trading 1-to-1 with the dollar. I looked at it yesterday, it's now trading at 3 cents. So a lot of crypto lenders going bust, Celsius networks, as we know about. But I think really crypto, it was an interesting idea back in the mid-2000s when it came along. But it's now tending to move the way of the equity markets. And as we know, the stock market's not doing that well right now. Inflation is high. And that's hit the crypto market very, very significantly. In fact, at its peak, it was worth in aggregate about $3 trillion. It's now below $1 trillion. It's got 2/3 of its value. So I don't believe that crypto in the bigger picture is going to be either a replacement for what's going on in terms of other currencies. Now, certainly you can go to a movie theater now and you can buy a ticket using Bitcoin. But in general, I think it's got a long way to go. However, blockchain technology, I think it's got a lot of usefulness within our economy, mainly because of its security. Here, got to get back to real estate. What's interesting about that is title insurance companies. I mean, they're responsible for verifying and ensuring that a buyer or a lender either gets clean ownership or a lien position on the land or on the house. Well, blockchain could change that because it is far more secure. 1/4 of all title reports have got some kind of defect on them today. And that could change because that obviously hits, you see a lot of fraudulent activity in that respect. So I think that blockchain, not just in housing, but in really across the gamut of the economy, is something which is not going to go away. However, crypto, I'm afraid, personally speaking, I'm just not a big fan of it.
Well, in that video that I just mentioned in March, there was information about how buyers could purchase homes, residential homes with cryptocurrency, which just means to me that crypto had gone mainstream. Like you said earlier, you can buy movie ticket with cryptocurrency.
Okay. But here's the trouble. Yes, there is one particular company that's out there, but here's what they're doing. They're saying, okay, you want to get let's say $500,000 mortgage. Okay, well, we'll give you those dollars because you still can't buy a house using crypto. And we will take the equivalent on a 1-for-1 basis of your cryptocurrency. We will hold it in perpetuity, in essence, until you sell the home. When you sell the home, you pay us back in cash and we will give you your cryptocurrency back. So that might sound great, but there's a couple of issues with it. One of which is we know cryptocurrency is remarkably volatile. Doesn't go the same way as the stock market. It trades 24 hours a day. And the problem with that is that, let's say you do a deal and you borrow money for a mortgage and you lend them that equivalent amount of crypto. But if the value of that cryptocurrency goes down beyond a certain point, well, then the lender's going to come to you. It's what's called a margin call. It's going to say, well, no, you've got to give us more cash.
Right. Collateral is gone down.
Exactly, or to make it work. And so that's a big issue. Now, outside of that, the reason why we're not seeing people either buying with crypto or indeed cashing out and then buying a house with the proceeds, capital gains taxes. They're going to be subject to a 35% tax. So we have a lot of people who have a certain amount of wealth within crypto, but they're just not comfortable selling it just because of the tax liability. Immediately they've got to come out and pay a lot of money in taxes.
Right. The tax trigger once you sell an asset have to hit you, and you have to have allocation separately to pay the IRS for that. So I think, in a former life, I'm aware of all these tax triggers when you liquidate assets. And crypto, I suppose if you plan it out correctly, you probably could do that. What is fascinating is I remember 10, 15 years ago, Bitcoin and these cryptocurrencies were not all that popular. In fact, I remember it being dropped down to $1. What is it today? I mean, at one point it went up to $50,000?
Oh, above that, yes. It certainly it was massive. And the biggest reason for that is that, well, as I mentioned earlier, inflation's back. And with tighter monetary policy, interest rates are going up significantly. And the era of plentiful dollars is coming to an end. And that's going to be a big issue for crypto, because the crypto market's never known anything but easy money.
Right.
Bitcoin, born, as I said, in the aftermath of the 2008 financial crisis. But then if we look at it right where we are today, it's a big problem because those dollars in essence aren't real. They exist in a virtual space.
Mm-hmm.
I mean, never were guaranteed by the Federal Reserve. So if a bank goes under, you can't say, well, pay me back because you're insured by the FDIC, as people are today. That doesn't exist. The Fed's got no obligation to help you out there. And so if you can't exchange your virtual dollars for real dollars on a one-to-one basis, well, the wealth, in essence, is actually an illusion. Do I think it's going to go away? No, I don't. I think at some point, we certainly know that the federal government's trying to figure out a way to allow them access to the broader financial markets. That will come in time, but right now there are so many out there. And quite frankly, when you have coins like, Shiba Inu is a good example. It was created as a joke, but even that ballooned for a short period of time. So I think that in one way, shape or form, crypto will continue, but it's certainly not going to replace the US currency, absolutely not. But it could find a place at some point down the road. But right now, it is just too volatile.
Right. Okay. Well, we're moving away from crypto and blockchain technology to the impact of rising interest rate in our region and across the United States. Can you share with us your thoughts on the impact of rising rates recently?
Rising mortgage rates or just interest rates in general?
Mortgage rates.
Mortgage rates, okay. Well, through the pandemic period, I'm sure we'll talk more about this a bit later on, we found mortgage rates drop significantly. In fact, to an all-time low of below 2.7% for a 30-year fixed mortgage. That has never been seen in the more than 50 years that the 30-year fix has been around. Now, we'll talk how that happened and why that happened maybe a bit later on. But as that occurred, people's buying power increased significantly. And it's something very simple called the 1 in 10 rule. For every 1 percentage point drop in mortgage rates, a buyer can afford to pay 10% more for a house and still keep their payment the same. So we saw a lot of demand. Obviously, a lot of demand was coming out from the pandemic anyway. People working from home, therefore looking to move further out. And the market became very, very vital, very, very busy, and certainly prices went up significantly. Well, that changed. And that changed at the start of this year. The Federal Reserve said that they were going to move from quantitative easing, which is in essence kind of lowering interest rates, increasing the money supply, to quantitative tightening, which is tightening the money supply and indeed therefore raising interest rates. Now, as interest rates, when they drop, you can buy more. When they increase, you can buy less. And again, it's the same 1 in 10 rule. So for the same payment, if mortgage rates move from 4% to 5%, you want to keep the payment the same, you can afford to pay 10% less for a house if mortgage rates are at 5. So when you do that, what's happening is that it decreases buying power. That ultimately is going to slow down significantly the pace of home price growth we've seen not just here, but across the country. But there's one more thing which is a bit more important to me, and that is first-time buyers. We have a lot of them. In fact, there's about 9 million millennials who'll be turning 30 over the course of the next 24 months. We have about 600,000 of them living here in King County. And quite frankly, they've never seen a mortgage rate above 5% since they've been an adult anyway. And they're scared. They want to buy a home, but all they're doing is seeing home prices go up and mortgage rates going up. And where rates are today, it's pricing a lot of would-be first-time buyers out of the market.
Interesting. So I remember just last year, there were a couple of dips and mortgage rate dropped down to around 2.5. And then once again, a few months later, 6 months or so later, back to 2.75 or around there before it suddenly rises rapidly in the last, I would say, year or so.
Yeah, really since the start of this year, yes.
Right. And what is it at now? Is it at hovering around 5% for?
At 5.5, actually, depending on who you talk to. If you talk to Fannie Mae or Freddie Mac, they're going to say it's around 5.4. If you look at the daily rate, it's actually closer to 6% today.
We have a question coming in from Michael Klein. What school of economic thought do you subscribe to? Canadian, Austrian?
I'm not a Friedman. I'm a classic Keynesian economist. So I'm a great believer that when economists are in contraction, when they're slowing down, governments should spend more money. It's the total opposite of Milton Friedman's thought process. So John Maynard Keynes, I actually wrote my dissertation about him back in college. So yeah, I'm an old Keynesian economist.
All right. In one of your other videos, you mentioned very briefly, and I'm very interested in learning what your thoughts are and what we can learn from the S&L, which is the savings and loans crisis in the 1980s, where interest rate was at the high teen at one point, as well as inflation rate. So, I don't know if we will head there in the future or not, but certainly our inflation rate is at, a 30-year high since, or 30 or 40 years high comparing to 1980s. So there, history tend to repeat itself, and we want to learn from our past. Can you share with our audience what your thoughts are of what happened in the 1980s, and then how you would compare that with today's economy?
Oh, wow. How long do we have? I will try and make it. It's a very, very broad subject, but quite frankly, a remarkably fascinating one as well. So to start off with, for those people who aren't that familiar with S&L, so savings loan banks were created back in, I think, 1932 via the Federal Home Loan Bank Act. And that was designed to encourage home ownership by giving banks, including savings and loans, a source of low-cost funds they can lend out in the form of mortgages. I mean, if you've ever watched It's a Wonderful Life, that's basically the same thing they did within that movie. Anyway, all was going well for them until about the mid-60s. And what happened then? Well, a thing called Regulation Q came in. And what that meant is that S&Ls, up until that point in time, they use short-term savings to fund long-term mortgages because they funded themselves through short-term deposits, either from other banks or savings from other people. This regulation, it put a limit on the interest rate that banks could pay on deposits. So what that meant is that they were often in a position whereby they were stuck with loans, long-term loans, which are mortgage loans at fixed rates. But because they couldn't raise short-term rates because of that regulation, they often had to pay more money to the depositors they borrowed money from than they were receiving in payments on that mortgage. So it was not looking good. And that was the mid-60s. So we haven't got to the 70s yet. Well, interest rates rose sharply in the second half of the 60s, and that hit them for the reasons I've mentioned. But they rose even more in the late 70s and the early 80s, and that hurt on a couple of fronts. Not only did borrowing costs for these banks rise, while the mortgage interest income they got didn't, but a lot of investors in S&Ls and in thrifts, they left those because they could make more money because the interest rate was higher at other banks. Mm-hmm. And it didn't help that at this time, money market accounts were actually created in the first place. So rates rose. What was going on with inflation, as you mentioned, and interest rates? It started in 74 because of the OPEC oil embargo. Basically stopped shipping out oil. That sent energy and therefore gas prices jumping. Happened again in 79 because of the Iranian revolution. And so what did that cause for inflation? Well, inflation hit 11%, even higher than we see today, both in 74 and 79. Okay, so what happens when inflation is rampant? We know what happens happening today. The Fed jumps in to try and fix it. And they didn't disappoint back then either. The Fed chair then was a gentleman called Paul Volcker, and he limited the money supply, again, which caused interest rates to go up. As we know, short-term rates, well, that got above 15%. And what did that mean? Well, S&L's lost about $2 billion in just 2 years. Mm-hmm. So they were hurting. What happens when the government sees that going on? Well, they jump in and they try and save the day. But quite frankly, all they did was make it worse. And they made it worse because they got rid of some of the restrictions in order to allow these thrifts and S&Ls to recover the losses. They therefore allowed them to make loans for commercial real estate projects and lots of other different things. And because of that, and actually thereafter in 82, Reagan, I think, signed in an act, the Garn-Saint-Germain Depository Institutions Act. Well, what that did is it took away the loan-to-value ratios and the interest rate caps as well. So because the government thought naively that if they allowed savings and loans to make higher yielding but riskier investments, they make more money, they would get straight again. Well, the trouble is that reward was uncoupled from risk. So we saw a lot of zombie thrifts out there. They were paying higher and higher interest rates to attract funds, kind of like a Ponzi scheme. And they were also investing in very risky real estate transactions and housing as well, and also junk bonds. The accounting they were using, even if they were losing money, it didn't show up on their books, so that everyone thought it was going to be great. But they didn't care. I didn't care because those losses, if they occurred, would be footed by who? By the taxpayer, by us, because the banks were insured through the Federal Loan Insurance Corporation. And that's what happened. So in 85, the Federal Savings Loan, that insurance company, who were then later on rolled into the FDIC, they had about $4.6 billion to cover losses. The losses were actually about $20 billion. Oh, so, yeah. So what do we remember from that point in time? Irresponsible lending was occurring. Mm-hmm. Right. Yeah, we saw that again in 2007, obviously. Yeah. We found a situation whereby banks didn't care because they knew that it wasn't going to come out of their pockets. In fact, during that period of time, there was a lot of theft going on within these S&Ls as well. They didn't care because the government was going to pay everyone off, so it didn't really matter. Again, very similar to what we saw today. So it was a very, very big issue back then. One would like to think we learned a lot from it, but 2007 still happened, so perhaps we didn't quite learn as much as we thought.
Right. Well, there's a certain level of accountability that we still have not seizing or tightening around the responsible parties, from what I can see around.
Well, if you talk about banks, but certainly, for example, now the SL crisis, it led to a lot of banking reforms, but it didn't cover everything. And because of that, there were similarities between what occurred then and what occurred in 2007. Now, where we are today, I think that is very different. But I mentioned irresponsible lending. Well, certainly that happened. Did that happen in 2007? Sure. Now, let's not forget, Washington Mutual. That was a savings and loan bank.
Right.
Imagine that.
2008.
Right.
Went down.
So Federal Stones and the insurance company, they were shut down. They were absorbed by the FDIC. Now, they were the ones that were insuring these bad loans. Now, what happened in 2007? Was it the FDIC? No, it wasn't. It was a company called AIG. These toxic mortgages. And again, they're the ones that got the massive bailout by the government, because the bank said, well, not our fault, pay us what you owe us on a one-to-one.
The big to fail kind of mentality was going on at the time. AIG, Lehman Brothers, all those guys. Right.
AIG they were the big insurer. Now, Lehman and Goldman, the rest of these guys, they're the ones packaging up these toxic mortgages and selling them on, knowing full well that they were almost worthless.
Risky assets.
It didn't matter because they were insured.
Right. Wow, very unfortunate. And you think that regulators have tightened up their rein with these banks and loans? Because lately, credit had gotten tighter. It is harder for people to purchase houses, but still, they're 2.7 trillion mortgage back.
That's owned by the Fed. Yeah.
Right. MBS, mortgage-backed securities. They're 2.7 trillion of them are still floating out there, from what I remember.
Actually, so the government, the Federal Reserve, hold about 2.7 trillion. The total value of mortgage-backed securities in the country is about $12 trillion. It's a lot more.
Trillions. Yeah. Okay, so that's floating out there with other companies being the backers of these MBS. Am I right?
They're backers. They're actually buyers of them. So for people that aren't that familiar, that when you get a mortgage for a house, the bank gives it to you or whoever. Now, normally what happens is that mortgage gets piled in with a lot of other mortgages and then sold on to the secondary mortgage market. And they're the ones that they don't buy individual mortgages, they buy blocks of them. And the same thing as we saw back in 2007. So that's the secondary mortgage market. Now, that in total is about $12 trillion, which makes sense because if you think about it based upon what the Fed has, that would assume that the total value of mortgages in the country is only less than 3 trillion. That's not the case. So they have got a significant chunk of that, but not all of it or even close to it.
Well, we're going to have to take a break for about 3 minutes, and we'll come back at 2:32, and we'll continue our discussion on federal government lending and quantitative easing with Matthew Gardner from Windermere Real Estate. He's the chief economist there. We'll be right back.
I'm Paul Pearson, host of Star Time. And when I'm not cooking up a batch of my famous wood-flavored chicken, I'm listening to Rainier Avenue Radio.world.
Ello and over, a friend has to eat, and the food just ain't no good.
Friends of the Waterfront, Saddle presents Pure Sounds, a free concert Saturday evening, the 3rd from 6 to 9 p.m. Come out see some sensational regional bands and artists, including Shawnee Shepherd, Fly Moon Royalty, Night Trade, Breaks, and Swells at the fabulous Pier 62. Enjoy live music, local food trucks, a beer garden, and all the sights and sounds of the wonderful Seattle waterfront. So don't miss Pier Sound's free concert series, Saturday, September 3rd, from 6 to 9 p.m., celebrating the fabulous summer of 2022. So for more info, visit peersounds.org.
Mga kaibigan, ito po si Kuya Bert Kawili.
And this is Miles Salvador from Australia.
And I'm Norb Kawili, also known as Norbcam.
Kung gusto niyo po ang latest news and events from the Philippines at yung local Filipino community, Phil Radio po.
We play Filipino music and interview guests from all around the world.
And I'll keep you updated on the latest Seahawks and sports news.
Kaya always tune in Phil Radio every Tuesday, 1 to 2:30 p.m. Pacific Time on Rainier Avenue Radio.world.
And in YouTube and Facebook. Salamat po.
This is your Rainier Avenue Radio.world community update on online Alcoholics Anonymous meetings. If you're looking for an AA meeting, find one every day online at aaphonemeetings.org. That's aaphonemeetings.org.
Hello, listener. What's important to you about what's going on in your community? Are you interested? Are you concerned? In any case, I invite you to tune into my show, Seattle Here and Now, on Rainier Avenue Radio.org. Why? I will be covering a wide range of topics important to you and impacting the community. Each show will have a special guest or guests to share with you information on a variety of subjects that are happening here and now in Seattle. I promise I will work hard to make my show informative, interesting, and entertaining. Be sure to listen to Seattle Here and Now on Rainier Avenue Radio.org.
Điều kỳ diệu nào đó sẽ xảy ra khi bạn thắt dây an toàn. Đó là điều kỳ diệu khi chúng ta đặt điện thoại của mình ngoài tầm với, hoặc cung cấp thêm chỗ cho ai đó từ xe đạp của họ. Một hành động nhỏ dừng lại để ai đó băng qua đường. Đó là một vẻ đẹp. Ngay cả việc vác xe về nhà sau khi uống rượu cũng rất anh hùng. Bởi vì tất cả những điều nhỏ nhặt đó đóng vai trò to lớn cho việc giữ an toàn cho chúng ta. Cùng nhau, chúng ta đến đó.
Would you like to see when your favorite Rainier Avenue Radio show comes on? Check out our show schedule, updated weekly at rainieravenue.radio.world.
Welcome to Rainier Avenue Radio. This is Afternoons with Monique, recording live in Seattle, Washington, every Thursday at 1 p.m.
And we back, Seattle. Today I have Mr. Matthew Gardner, Chief Economist at Windermere Real Estate, on Afternoons with Monique. He is responsible for analyzing and interpreting economic data and its impact on the real estate market on both a local and national level. He has 25 years of professional experience both in the US and the UK. He currently sits on the Urban Land Institute Technology Assistance Panel and is on advisory panel, board member of the Randstad Department of Real Estate at the University of Washington. Please welcome back to Afternoons with Monique, Mr. Matthew Gardner.
Well, glad to be back again, Monique.
Yes. So before the break, we were talking about mortgage-backed security and how the government bail out and the taxpayer end up having to pay for all these insurance companies to compensate or recompense all those failed mortgages back in the 1980s, as well as 2007, 2008 housing debacle. And now we're having a situation where inflation is running rampant, and we're comparing the period we're in to part of the period in the 1980s when the savings and loans crisis were experiencing also very high inflation, which leads, well, I don't know if it leads to, but it correlates with high interest rates from the government. So we are hoping to observe some lessons from history here in order to maybe learn a thing or two from our past and contribute to our prediction or decision in the future. So before the break, Mr. Gardner, you were sharing with our audience about the mortgage-backed security of 2007 and 2008. And I've asked you to also compare and contrast with that previous period of savings and loans where I believe the government was easing quantitatively with easy lending and providing, and I actually don't know if the government was also pumping bonds into the systems the way they do recently. So can you comment on the quantitative easing of last year and during the pandemic versus what they're doing now? Are they tightening it up a little bit or is it more aggressive than you anticipate? What's your opinion on the recent, the pandemic quantitative easing and the recent reverse of course?
Right. Now, as we talked about, the Fed has about a $2.7 trillion balance sheet when it comes to mortgage-backed securities and 10-year treasuries. And I explained that we also did that for one particular reason, and that was they wanted to lower interest rates to keep the economy stimulated. Now, the Fed became a major buyer of mortgages because they were trying to stabilize the economy. They went out to make money, and they were happy to accept lower returns on that investment if it was going to stabilize the US economy through the pandemic period. And that allowed mortgage rates to drop. Well, when they announced back in January that they were not going to continue buying new MBS paper, now they are going to reinvest the proceeds of old maturities, but that is what led mortgage rates to double, and that is quantitative tightening. The reason why mortgage rates double is that if the Fed is not a buyer at low interest rates, you've got to find somebody else to buy these mortgages.
Right.
Again, we talked about it a bit earlier. And given where inflation is, then naturally investors want a higher return, and that's what's pushed them up. So they are tightening. Now, the problem with it, we talk about tightening, is that no one, quite frankly, is too sure what actually happens when quantitative tightening concludes. And the reason why I say that is that we've tried it before, but it's an interesting situation that they've tried to tighten of the money market, again, money supply, and that raises interest rates, obviously, but they've never actually done it in its entirety before, and that's the trouble. They did try it, obviously, post 2007, but then they stopped, and so who knows how it's going to end up. Now, it's quantitative easing implemented in 2007 at the financial crisis, but they didn't start tightening until 2018, to be exact. But less than a year later, they stopped because of the impacts they saw from that tightening. That was an economy slowing far quicker. So ultimately, we as economists and even the Fed don't really know what happens at the completion of QT because they've never actually got it all the way through. I mean, implementing it involves striking a very delicate balance between removing money from the system whilst not destabilizing the financial markets. So that's what everyone's looking at right now. And so we will certainly see, but that is part of the reason why when they made that announcement, a lot of economists, including myself, believe that it is not guaranteed, but it is quite likely that we will see a recession sometime in 2023. The trouble is, you mentioned the R word. Everyone thinks we're back in 2007. No, we're not. It's not driven by housing, but it's because the fact it's quite likely the Fed will keep on tightening past a point that they should. And that's actually fairly normal for them to do. They've done it before. So soft landings from the Fed, economists always joke, are a great rarity because they do tend to do either too little too late or too much and carried on for too long.
Overshoot or undershoot, but never quite perfect because we are human, and predictive values of multiple people in the government can make that landing, like you said, cause a lot of vibration to the plane. There is a question coming in from William Hochberg. He would like to know how to expand the housing market, especially the middle and lower income individuals, whether they should buy or rent at this point.
Right. And William, great question. Thank you very much for that. I'm sure he doesn't know me, but anyone that does knows I've been a big proponent of what I call the missing middle housing. Now, what is that? Well, we fail in providing ownership housing opportunities for some of our most crucial employees. When I say that, I'm talking about teachers, nurses, firefighters, executive assistants, these kind of people out there who are very important, but they've been priced out of so many markets. Now, what's going on there? It's happening across the country. We know we have a shortage of almost 4 million housing units today, and that's fine. But here in Washington State, we've limited where people can and cannot build. We created a thing called urban growth boundaries through the Growth Management Act back in 1990. Now, inside these boundaries, you could build houses. Outside of them, it's 1 house per 5 acres or 1 house per 20 acres. Okay, that's one thing. Now, when they did this, zoning actually in Washington State was created back in the late 20s, early 30s, and it probably made sense from that point through until maybe the early 70s. But it makes no sense now. And the great example I'll give you is this. City of Seattle, here where I'm based, 72% of the residential land in the city, Northgate to South Center, is zoned single family. Does that make any sense? No, it does not. Because we are surrounded by single family housing. Yet, if we were to change the zoning laws, which we are already seeing, it first started happening in Minneapolis in 2017, in Oregon 2019, even Governor Newsom in January of this year signed a law across the state of California, allowing you to build duplexes or 3 or 4 unit buildings on any single family zoned lot. We're not saying we're getting rid of single family zoning, just allowing that to happen. We're not going to make any more land. We're not going to fill in Elliott Bay. We need to figure out that, given that being the case, that we need to look at zoning laws and decide whether they are appropriate today as they were back then. And I would argue all day long that they're not. And a good example of this I'll give you is that if we look at households making median income, for example, the average potential first-time buyer household, looking at what they would make, looking at a home price, discounting that to about 85% and lowering down the down payment, technically speaking, there's only one state in the state of Washington that is affordable to a first-time buyer. That's Lincoln County. Most people don't even know where Lincoln County is. No. It's out anyway towards Spokane, but it's a long ways away. But that is a big problem. And so it is something now. Governor Inslee did introduce a bill into the Senate that was similar to the Oregon, California, and Minneapolis bills, but it just it wasn't robust enough. It failed. I'm hopeful that a better form of that will come back, because the only way we can address this imbalance is very simple. Go back to Econ 401 classes at college. Add more supply. We know we've got the demand. And that in turn is going to allow price growth to slow down, and you can provide housing which is more affordable. It's a big, big worry that I have. If we don't do it, then I'm quite not sure how we can continue to grow as an economy in our region.
Now, do you think that the recent printing of trillions of dollars of pumping money into the system to spur the economy, some people think that overshot and caused inflation? Do you believe that?
No, I mean it's very easy to conflate things and try and make the housing, try and shoehorn what happened in 2007 to the housing market today, and you can't do that. I mean, credit quality is significantly higher. I mean, back then we had these ridiculous loans options out there. My all-time favorite, by the way, is the zero down option arm with cash back at closing. What that meant was that no down payment. In essence, you're getting 105% mortgage if you want. You're getting money back. An option arm means that you could choose to make a payment if you wanted to. If you didn't, then it just went on to the back end of the loan. What could possibly go wrong? And what happened then is that almost all subprime mortgages were ARMs, adjustable rate mortgages. They adjusted at the end of 2007. People found their mortgage payments doubling. They had no equity in their homes. They literally did one thing back then, an old banker told me, is that they used to call it jingle mail. Because people were mailing the keys to their home back to the bank and walking away. And so a really quite extraordinary situation there. But today, the differences are actually quite phenomenal. I did look it up, and in the second quarter of this year, I believe, more than 60%, 66% of homeowners in King County had more than 50% equity in their homes.
Wow, really?
Nationally, the number is 48. But it's a remarkable. So we are sat on a huge, huge cushion should anything go potentially bad.
Interesting.
Whereas the government have been printing money, now they're stopping. Now they're actually removing money from the money supply, which is what the Fed does. Their holdings of mortgages, I mean, the mortgage default rate right now is a rounding error, very, very small. And so am I concerned about it? No, because they are moving to tightening, right? They're not printing. And they're actually, look at the federal deficit, it's coming down significantly from the bigger lending that they did through the course of the pandemic. So it is getting better. And I certainly do not expect us to be back in a similar situation that we were back in the late 70s or indeed early 80s.
Right. I appreciate that. And thank you for the great answer. William actually wanted to ask you, he's a government kind of guy. So he wants to know, other than zoning, is there government support that can be done?
Yeah. So zoning we talked about, I think that there's several other things. Streamlining the permit process is going to be important, because that gives builders some kind of predictability, some kind of surety. It's not going to be hanging up for years trying to get their permits. They know they've got an outlay, they've spent money on acquiring the land. So that is something which we could do. I think there's also, we need to quite frankly look at the regulatory environment in terms of fees. I need to double check on what the number is locally, but I can tell you a national number, and that is about 25% of the cost of building a home are fees.
Wow, really?
Permit fees,
A lot of money.
water sewer hookup fees, entitlement fees, fees. And across the country, that equates to about $100,000.
Wow.
So that is another way we can look at it. I think you can also start looking at some tax increment pricing. There's some tax vehicles out there which we could think about. How could those be incorporated? But the low-hanging fruit, quite frankly, are fees. But there's one other one. I talked about zoning changes and allowing denser development. So let's say you buy 2 houses that are falling down, you can replace those with 14 townhomes, for example.
Right.
And we've seen that happen already. But it's very hard. It's like chasing cats to try and get the owners of those homes to agree to sell, and at what price. Even today, they're still going to get a lot of money, which means the homes you replace those 2 teardowns with have to be expensive. So that is one issue unto itself. But I think that we need to start thinking about, let's look at land that's owned by cities, that's owned by the county, maybe by the state, that's owned by public utility districts. Now, this is low-hanging fruit. This is land which can be potentially vacant, do a contract rezone, you can start building. And a lot more can be done a lot quicker, because although we'll see zoning changes, because we are, in essence, built out already, and we're not going to be building on golf courses, as some have suggested, it means that even though we've seen those zoning changes in these several states, it doesn't mean the impact's going to be immediate. It's going to take a long time for that to really work through the system, because we are built out already, and there is no political will to expand our urban growth boundaries. So I think there's some land out there we can look at. I think there's some fee structures that we can look at as well, streamlining permitting. Beyond zoning, and when I say zoning, you could actually look at reduced setbacks, changing minimum lot sizes, reducing those, increasing the minimum density per acre. So, but again, those are kind of zoning things. But the other things that I mentioned are ones which could have a fairly palpable and fairly quick impact on the housing market.
Well, thank you for that answer, and thank you, William, for sending in your question just now. Let's get back to the local economy. Real estate market in the local market has not been impacted as much as the rest of the country, where I hear California, Arizona, Florida, they've been hit hard with a certain, I think up to 20% or 15% correction in some places, but we have not been affected as much. And actually, those numbers could be wrong if you want to correct me, the national average, I don't know actually, but locally, we don't see that much being affected in King County or Seattle. Do you think that is coming, or we are pretty insulated from the rest of the country in terms of pricing?
No, it's funny. For years, as long as I've been in Seattle, I've heard it once, I've heard it 1,000 times. We are special here. Everything's going to be great because we're from Seattle.
Right.
Let's think what happened in 2007 proved not to be the case.
Right.
I tend to ignore sale prices, quite frankly, because those are what I call a lagging indicator. That's looking backwards. I like to look at list prices, how much people are asking for their homes. And we've actually started to see those roll over. So we've actually seen a reduction in both average and median list prices. So what does that mean? That means that the pace of sale price growth has to slow. It's just mathematics, and we'll see that. But what we are doing is what economists refer to as reverting to the mean. So we are actually going to get back to a more normalized pace of appreciation that we saw leading up to, say, 2019.
Right.
And really ignoring that 2021 blip, which is really what it was through the pandemic period. Now, will it overcorrect? Potentially, yes. But again, I don't like people who look at the value of their homes day in, day out. And it should be your home first and an asset second. The longer term increase in King County for 30 years, prices have risen on average about 5.5%. Not the 20+% that we saw.
Right. The last couple of years, yeah.
So we're going to go back to that. Could we overshoot a bit? That is possible. But I'm less worried about our market here than certain others. And those would be, Boise is a very good example. Boise home prices have almost tripled in 3 years. Not sustainable. So I think those, and they're mainly in those secondary and tertiary market areas. they're ones that are likely to see a bigger contraction. But even then, it's going to be pulling back to that long-term average. It might cause pain to home sellers if they bought high and they have to sell far sooner than they thought. But for anyone, even if you bought in 2020 or even 2021, assume the fact you're going to live in your home anywhere between 7 and 10 years on average, I will guarantee you that home price when you sell will be higher than what you paid for it on the longer term. But it's those short-term changes that can have certainly an impact. But in general, we're just trending back to where we need to be. And I'm remarkably happy about that. Markets going up by 10, 20% per year, unsustainable. And nothing ever good has come from any market that's done that for too long.
Now, I have a question. How big is Windermere? Is that a Pacific Northwest company only, or is that a West Coast, along West Coast? What's your territory?
Basically, the Western United States. We're in the 10 Western states, as far east as Colorado, north, Montana, Idaho, obviously up in Bellingham. We have offices up there, south to San Diego. So we're in essence the 10 Western states and have a small presence in the Baja Peninsula down in Mexico. Size-wise, we have about 330 offices and a bit more than 6,600 brokers within the company.
Right. It's one of the biggest, if not the biggest.
Privately held ones, yeah.
In the Northwest and possibly West Coast.
Certainly the biggest privately held one in the Northwest, absolutely.
Right. So you cover a big territory. That's why we're talking about the real estate market in the region and then also the rest of the country. But do you feel, based on what you just said just now, is it safe to say that you're optimistic with the level of growth in terms of price and the stability of the Pacific Northwest real estate market? Because some people might feel that, the last few years and the last even 10 years since 2012 and 13, when things start, getting to more stabilized level, that big investors or homeowners, home purchasers have gained confidence and jump into the market with the quantitative easing and the low interest rate. Yep. That is coming to kind of an end era where where tightening is happening. Interest rates at 5.5%, you said earlier. So 5.5, I remember that was between 2000 and 2010. That was the average rate at the time as well.
Oh, sure. I mean, the long-term average since the 30 years since it was created back in the early 70s is actually 7.5%. So
it's still low.
It's still relatively speaking low if you think about it in its entirety. You mentioned 2012. Well done for that. That was the bottom years when prices started increasing. And you say, well, look, between 2012 and now, and look where prices have gone. We have to remember, again, we saw a significant drop in price from 2007 to 2012. Mm-hmm. So part of that increase was just getting us back up to where we need to be. Again, reverting to the mean, but in opposite. So am I concerned? No, I'm not. I think for everyone, we should think of our homes as our homes first.
Yes.
And as
an investment second.
Right. But a couple of other things come into play as well. Yes, people talk about comparing the value of homes and the appreciation to stocks. Well, there's no real comparison. Since 1990, home prices across America up about 325%. S&P over 1,000. So in that respect. However, what I think owning a home is a smart move not for everyone, but for a lot of people for several reasons. One, it's forced savings, because every month when you make that mortgage payment, a very small part of that payment is coming off the principal. That part gets bigger over time, obviously, but it uses leverage. It uses other people's money to buy a home. Mm-hmm. So you get the benefit of price appreciation on somebody else's money, quite frankly.
Right.
And home leverage is much greater when it's used to borrow home money for a home than using your own cash. So you can build sweat equity as well. I mean, if the home needs renovation, you can do that. Again, you'll be building up value as well. Tax benefits, depending on if you itemize your tax or not, then you'll be able to deduct that interest on
nature.
Payment. Yeah. But most importantly, housing and ownership housing is a very solid hedge against inflation. What do I mean by that? Well, there's only been 2 periods in history where the annual rate of inflation has been higher than the annual rate of home prices. So whereas with other assets, they can be dropping because of where inflation is, doesn't apply to the housing dollars. But more importantly is that over time, your mortgage payment's not going to change. Now, if you're renting, then every year, that 18 months, we talked about that can go up. But it doesn't. But also, the value of dollars over time goes down. So your mortgage payment today will be the same as it is in 3 years' time.
Right.
But hopefully in 3 years' time, you're making that much more. So the share of your income continues to drop. And the bottom line, it really is houses are tangible assets. They're not paper. And their values historically over the last 110 years do tend to keep up with inflation, don't necessarily exceed it. But on the longer term, I'm not worried at all. But I am worried about affordability. I am worried about our younger generation, millennials, and even Gen Z after that. What can they afford to buy when it comes time for them to look to buy a home?
Right.
But owning a home is not for everyone. I certainly get that. But if you're prepared, you're comfortable with that debt level you're taking on, comfortable with your employment, and believe you're going to live in that home, in my opinion, for at least 7 years, I see no reason that you'll have anything negative at the end of the day when you come to move. And you certainly will be building up equity. And finally, the long part is that you only see prices go down significantly when there's a big supply increase.
Mm-hmm.
Kicker. Imagine you or your listeners or viewers are watching this, and imagine the year's 2025, and imagine mortgage rates have normalized at 6.5%, where they likely will be, possibly. And you're sat on your 2 5/8 30-year fixed or a 2% 20. Are you going to sell? I would argue a lot of people won't. That means we're not going to see the turnover in homes. And if we don't see that, that actually allows for even more price stability and prices to rise at a modestly faster rate, because we're still creating households. But a lot of people probably, unless they have to move, won't, because if they do, they will lose that never seen before, likely never seen again mortgage rate.
Well, there you have it, folks. Matthew Gardner from Windermere Real Estate. He's a chief economist there, and he has a show. Is it on Como?
With radio. With
radio.
Dave Ross. Yeah.
With Dave Ross. How often can people?
That's once a month. That actually comes out at the same time that the housing numbers for the region come out. So it will probably be this month. It's probably going to be either Monday or Tuesday. So yeah, I've done that every month with Dave and Colleen O'Brien for 3 years now. It's a fun chat we have. Dave always likes to take me off on tangents. So it's kind of like yourself, Monique.
Well, thank you so much for joining me on Afternoons with Monique. We look forward to having you on again. I'm sure to update our local people with U.S. and Pacific Northwest economy.
I'd be delighted. Thank you so much for having me.
You're welcome. Next week, we'll have 3 financial and business experts: Seth Rudin from IBA Business Broker, Addie Rosberg from Live Oak Bank, and Keel Larson, who is a business attorney, on Afternoons with Monique on episode number 107. Please tune in next week, September 8th, to catch another episode of Afternoons with Monique. Have a good afternoon, everybody.